Ayanlakun. Welcome, Mr. Samuel Ayanlakun. I'm sorry if I couldn't pronounce your name well, pardon me. Thank you, Mr. Samuel. You can take it off from here.
Thank you so much, everyone. My name is Samuel Ayanlakun. It's Samuel Ayanlakun. I hope you cannot hear me.
Loud and clear.
Let me know if you can all hear me, please. So I can
We can hear
proceed.
you, sir. We can hear you.
All right. Thank you. So my name is Samuel Ayanlakun. That's my name. And welcome you all once again to the call, to the class. And we shall be, just as our moderator has said, we shall be talking about...
Hello, Mr. Samuel, please. One of the students can't hear you. Please, can you increase your volume?
Okay.
Thank you. Please, when you hear, let us know. Thank you.
So hello, can you hear me? Am I loud and clear?
I can hear you. Your voice is breaking. Your voice is breaking. I don't know if it's your network that is breaking.
Oh, it could be network. You know, these days it could be network.
I think from my end, the voice is very clear and the network is also clear.
Thank you. Thank you. So that means from your end. So let's kickstart. So I would like to first of all, let me share my screen so you all can see what we have for today. What we have for today. Can you all see my screen?
Yes, your screen is displayed.
Thank you. Thank you. So we'll be looking at, as you know, the program is a business management and information technology. So, and our course title for this morning will be Principle of Accounting 1. Principle of Accounting 1. That is our course title for today. And at the end of this lecture, our objective or what we want to achieve today is that we need to know the history and the principle, the roles, the concepts, the convention of accounting. We're all familiar with accounting. So we need to know the history, how it comes about, the principles, the role, the concept, the convention of accounting. We're going to talk about that. We need to understand the principle of double entry also. The principle of double entry, we'll be talking extensively on that. We need to know the capital and the revenue item. We need to know the books of original entry. As a student, you need to know the books of original entry. So you need to know how to use ledger also. How to use the ledger. The use of ledger, we need to know that. And also we need to extract trial balance. You need to know how to extract trial balance. And also, you need to know the uses of journals. The uses of journals and understanding bank reconciliation statements. Understanding bank reconciliation statements. Then also depreciation of account. Depreciation of account, we'll be talking about that. And at our next lecture, then because we have a lot on our table. So we just pray. I hope that we'll be able to catch up everything, work on everything, teach about everything. Then our next lecture, we'll be talking about understanding accruals and prepayments, and now looking at the final account, which will be now be looking at the calculation, the practical aspects of accounting. I guess we all understood what I'm talking about. So this is our aim, this is our objective for this morning. This is our objective for this morning. So please, if you're following, can you please indicate, let me know that you're following me. So it won't just be a monologue. It's going to be an interactive session. We're going to be talking, we dialogue, so to know that, yes, we are all active on the call. So can someone just tell me that, yes, you are with me? Is everybody with me? Can someone just talk if you're with me? And if I'm still on, so it won't be like I'm just talking and nobody's hearing me. Yes?
Students, please feel free to chat in the chat room, respond to the lecturer, and let him know that you are all following.
Yeah, all right. So Abel Adalgo said, I'm with you. Thank you so much. Yeah, good. So let's now start. So as we said, first, we'll be looking at the history of accounting. But first of all, we need to know first, what is accounting? What is accounting? These are things we need to first of all know. We need to know what exactly we're talking about. We need to know what exactly we're talking about. So I'm trying to explain. So before we talk about accounting, we'll first of all talk about bookkeeping. Bookkeeping, this is a very important topic you need to understand. So bookkeeping and accounting, that's what we call it, bookkeeping and an accounting. So what is bookkeeping? As you can see it on my screen, that the bookkeeping is the act of recording and classifying financial transactions. That is to say that every transaction you make, just look at the shop you see on the roadside, somebody selling spare parts or thereabout, or selling food stuff. You see, according as he or she is making the sales, what does it do? It tries to record. You open the book, it has a book, it's trying to record. Madam so bought this quantity, and this amount of a bulk pan. You start seeing them putting on the record, recording it. So that's bookkeeping. And it's very important for every business, there must be a record keeping. There must be a record keeping. There must be. So it's the act of recording it and classifying those financial transactions in a systematic manner. You record it as it comes, as customer comes in, as we buy. You keep record of everything. You keep record of everything. If they pay cash, you record it that it was cash that was collected. If it was check, you record it is check. It was taken. If the good was sold on credit, you need to record it too. In order for you to be able to follow it up with getting back your cash, maybe at the nearest future. It depends on what you guys plan and the time or your agreement on collection of such payment of such goods. So it's recording of every transaction you make. That is bookkeeping. So we need to know that. We need to know that. It's quite different from accounting. So this bookkeeping, before you start anything, the first thing that comes in is the bookkeeping. Then we now talk about accounting. See what bookkeeping says. Recording and classifying of transactions. And I've made example. Every shop you go to, those who are mindful of, those who are business oriented, they always keep record. You go to pharmacist shop, you see them having record. Go to Mr. Chinedu's shop, so you see them having record. You see the apprentice keeping record as it's being sold, as it's going out, as good is going out. They keep record of everything, and good is coming in. If the supplier brings in the goods, they keep record of everything. So that's bookkeeping. But when it comes to accounting, that is now an extension, and an extension of what we're talking about. So accounting is defined as recording. As you also know that bookkeeping is recording. As you also know that bookkeeping is classifying. Accounting too is classifying too. Accounting is creating. Accounting is summarizing. Accounting is communicating. Accounting is interpreting. You can see the difference. So it is from where a particular place stops, where bookkeeping stops, then accounting starts. Where booking stops, accounting starts. Accounting is defined as recording, classifying, creating, summarizing, communicating, analyzing, interpreting. You need to interpret. So that's the work of an accountant. You create it, you record it, you classify it, you create it, you summarize it, and communicate it, and you interpret it. when you see the financial record, you should be able to interpret it to the management. Oh, for this, so, looking at the statement of account, we have discovered that this and this is getting too high and it will affect us in the future, or we made so much in this social aspect, then we need to appreciate, or we need to increase the staff welfare, we need to appreciate the effort they've made, because you will see everything on the financial statement. That is analyzing, interpreting it. So interpreting financial statement to interested parties, those who are interested in it. You know, every person is an interested party to the financial statement, so as to help make specific business decisions. So that will make you have specific decisions, make informed business decisions. So that is what accounting is. I hope I'm clear, no? I hope if you understand that, please, can you from the chat box, you can just say something. You can just say something. If you now know the difference between bookkeeping and accounting. So just say something, so I'll be able to see it. So, and looking at this bookkeeping and accounting, what is the difference? The difference between bookkeeping and accounting. There's a difference. There is a great difference between bookkeeping and accounting. So you can see, as I've said, that bookkeeping is just recording, classifying a transaction that just ordinary person who has active memory can do. Just record and classify it. Your boss or your other at the shop or something tell you, just keep record of it, and that's all, and that's what you do. But accounting is more. We have more to do when it comes to accounting, which is the recording, the classifying, the summarizing, the analyzing, the interpreting financial statements, interpreting of the financial statements. That's one. And also, it involves the routine recording of transactions. That's for bookkeeping, involves routine recording of transactions, and it is very simple. It is very simple. Just take your biro. If you go to school, you're a little person, you can write and everything, just get a book, then start recording it. So it's very simple. Bookkeeping is very simple. But when it comes to accounting, it is complex. It is complex. The complex does not mean that it's not what you can understand, but it is far beyond just keeping record. That is what we're talking about here. It's complex. It's involved designing the accounting system, because there are more to do when it comes to accounting. So when it comes to bookkeeping, it's just for you to record this also dates, we sold this, the quantity, the amount, and thereabout. But when it comes to accounting, after writing the made payment for these, you have to create your ledger, you have to create your trial balance with the final account, that the profit and loss account, with the balance sheet, interpret it to the management, and for other shareholders or stakeholders to be able to see and grab one of the things from it in order to make decisions. So that's why we say it's more complex. It's more complex. So it is also, bookkeeping also is only a small part of the field of accounting, and is limited in scope. As I've said, it's just a minute part of accounting, minute part of accounting. Why accounting goes beyond recording transactions and the wider scope. As I've said, we're talking about final account, we're talking about the trial balance, we're talking about, there's nothing under bookkeeping, bookkeeping has no business with trial balance or balance sheet or profit and loss account. But when it comes to account, you have to do all this in wider scope. So what? A few days, a few hours, and everything, you have been told. You're being told this is how you should do it. Sorry, can you hear me, please? If you're following it, please, on the chat box, can you please say that? Let me know. So if you are still following me and there's no network glitches, please let me know. Oh, I can Thank you. So, as I've said, one can be proficient, you can be a proficient bookkeeper, and everyone can do that. Everyone can do that, irrespective of where you come from, and in as much you can read and you can write. So, in few days, few hours, a few weeks, you can be a bookkeeper. But as an accountant, you cannot learn that in daily. You can't learn that. It takes 4 years for you to learn that in school. That when now comes to Nigerian school, that's 4 plus X. You know what X is when strike comes in and everything. So you have to learn it because it's a profession, it's a discipline on its own. And it has tentacles where exactly do you want to go? Are you going to be the tax account? Are you going to aspect of tax? Are you going to aspect of cost? Are you going to aspect of finance? Are you going to aspect of different aspects? So it depends on where you now really want to branch to. So that's now what they're doing. So you have to become a professional accountant. That is where ICANN comes in. That's where ICANN comes in. They have to make sure that you are professional. You are satisfied that yes, the country has made you are now a professional accountant. So that is, and you have to have years of study and experience. So these are the difference between bookkeeping and accounts. These are the difference between bookkeeping and account. These are the difference between bookkeeping and account. So do you understand? Do you understand? Please let me know. Please let me know if there's any gray area you want me to touch on. Please do not hesitate not to ask at the right time. So now we're looking at history of accounting. How did it come to existence? How did it come to existence? How did it come to existence? And these have been in existence in thousands of years BC, for pride, with engaging four great grandfathers and everything. So it can be traced back to the ancient civilization of Egypt, in Rome, and everything. So where they begin to have record, when there's trade, during the time when you have flocks of sheep and everything, put down something. You have to record something. You have to pay tax and to know they look at what you have, they pay tax on those things. And it has been so way back then, during those times of ancient civilization, when civilization started, the ancient Rome, where basic record keeping was prevalent. Records, so clay, token, photographs were done, ledger were used to track goods, they pay taxes, and transaction also too. Pay taxes and transaction where rudimental, pay tax. These are forms of accounting where rudimentary, they were just rudimentary, they were just elementary at that time. It was nothing so complex at that time, they were just elementary. Just put the record on it. That was the early beginning of accounts, and that laid the groundwork. So then we move to the medieval era. Then the medieval era. So it was advancing. So it rise to the time of trade and commerce, where now they were more of trade. Now you see people having more of trade, having commerce too much with having those micro and micro trading, micro and everything that we're having. So and at that time we have a man whom we call an Italian monk. His name is Lucas Pacioli. So that was the man. He was the one who developed double entry principle. He developed double entry principle. He's a monk, he's a great monk, he's an Italian monk, and he's also a merchant. So he developed this double entry principle, double entry bookkeeping in the 14th century. So, and he called his book Summa de Arithmetica. And from there, that has now become a bedrock, the foundation of which accounting was built upon to innovate, to evolve to this present stage we have. That's the medieval time. And it comes to the industrial revolution at that time where everything is now getting boom. Everything is now moving fine. In America, during those industrialized area where we have the great men of Carnegie, we have the Rockefellers, where the time of Henry Ford, where the whole country was industrialized, that they even have the power to even take up government, have the power to take up government. So we now have so many of trade whereby accounting has now to be, you now have to structure an accounting in a way, you have to standardize it, it has to be accurate at that time. So businesses expanded at that time, prompting the need for more accurate and standard accounting method. Also, we have to, because of too much now trade and everything, we need to expand accounting. They need to standardize it. It has to be the same all over and everything. So, and principles were created that if we need to standardize this accounting, then there are some principles, there are some conventions, there are some concepts we need to follow all through, so that anywhere, everywhere it is being taken to is the same thing. So we'll still talk about it when we talk about principles of accounting. And if we're talking about principle, we know what it is. That means these are what we are following. This is what we want to follow. This is how it's going to be done, no matter what. So another time at this industrial revolution era, so they were professional bodies that come together, that we have the IACPA, that's the American Institute of Certified Public Accounts. We have the CIMAN, that's Certified Institute of Management Account and everything. So we have different establishments in order to make sure that accounting progresses and everything. When you now begin to see that there's need for us to expand the tentacle, there's need for us to standardize it. And there's the need for us to be current, to be up to date with modern day events that happened at that time. So that's about the Industrial Revolution. And comes to the 20th century. The 20th century. So you see the evolution of accounting. See the evolution out from the beginning to this 20th century. So at that time, we can now see so like civilization now start occurring. People are being civilized, then you now have more of the economy in the country, more of transaction and everything. So it's witnessed a surge. There was more development, and as commerce was developing, accounting too was developing. Accounting standards was developing, and they're making standards, they're making convention for this in order to ensure transparency and reliability in financial reports. So as accounting evolved, as it was evolving, to be making some concepts and convention just to ensure transparency. Another time, United States too, that's the SEC, the Security and Exchange Commission, was established in response to the stock market in 1929. At that time, to when there is stock, so we need to have a Security and Exchange Commission, a commission established for markets or shares and everything, to able to monitor it at that time. And furthermore, also there was also gap in this 20th century. Gap, generally accepted accounting principle. So it was created, and the International Financial Reporting Standard, which we still have up to this time. This is the body that regulates accounting up to this time. So we have all those standards. If you look at it when you advanced stages, we go further in reading accounting, we will know all these standards. IFRS has created these standards for everyone to follow suit. So when you're in Nigeria, you follow the standard. The same standard that's followed in Nigeria is also followed in anywhere, either Afghanistan or US or in South Africa and everything. These are the standards. In as much you are within the same industry, you are within the same industry. And we now see what has happened. And the modern era where we can see that accounting has evolved, where you have some ERP that we use, in making it easy. AI too has been established, also has come to being, has come to existence. Technology has changed a whole lot of things, a whole lot of things, a whole lot of things. It has changed a whole lot of things. So, and that comes to an advanced level. So, advancement in technological revolution, accounting practices. So you have the advent of computer, there are software, there are ARPs that will make your accounting seamless, simple, and easy to do. So, and it makes your work more efficient, to make it accurate also, to make it efficient, to make it accurate and everything. So, and that's what we can see in this modern day, in this era we have, in this Gen Z we have now, even in another generation after Gen Z now, the alpha. So we don't know what alpha will be bringing in for us. We don't know what alpha. Hello, can you hear me now? I guess network happened. Hello, Madam Edith?
Yes, we can hear you. But you are still breaking.
Just 1 minute. So we'll be moving to accounting equation. If you can hear me, please let me know. If you can hear me, please, from the chat room, please let me know so I can. All right, thank you. Okay, you can't see my screen. Okay, let me just fix with that. All right, all right, all right. So I guess you can see my screen now. So modern day, where I stopped before the network interject. So as I was saying, AI. So I would like someone to tell me, regards to this AI, do you think that this advent of AI would take accounting profession down the drain? Will it eliminate accounting as a profession? Will it eliminate it completely? I'd like someone to tell me, what is your opinion? What do you think? Or what do you think? Has AI come to help us as an accountant, or has help to let accounting extinct? Yes, someone can talk. So someone can talk. I'd like to, before I move further, what is your take on AI, artificial intelligence? What is your take on that? What is your take on that? Anyone? Anyone? Or if it's from the chat box, you can say something. No? Okay. So let's waste our time. Let's just move further. But I will always say that AI has come to stay, you like it or not, and you can see what AI has been doing to every discipline of profession. So it is now time. Though people say that AI has come and it's going to take a lot of jobs, it take a lot of jobs from people and everything. You might be right, you might be wrong. But all I will say is that AI is only going to take job from those who don't know how to use AI. Because AI is here to enhance your job, to make your job more efficient, more accurate. So if you're a manager at your work and you give your staff a job to do, and he does not know how to make use of the AI at this modern world, at this modern era, and he does not know how to use, to apply AI to make his job done, what would you do to that staff? You want to send him out. You want to take him out from your organization. And you want to employ someone who can use his AI, the AI to blend with his job, to complement his job, to make his work more efficient, more accurate, more interesting, and more transparent. So that is AI for you. That is AI for you. So let's proceed. So importance of bookkeeping. Why are we keeping this bookkeeping? There must be a reason for keeping this bookkeeping. Why? Are you just keeping it for keeping it sake? Are you just keeping it for because my boss told me, my MD told me, or my line manager told me that I must keep it? You must keep, every record must be kept. The only thing, I always say, the only thing that you will always do is to give account. Even after this earth, you will still give account. And you know who to give account to. Give account to God. So your keeping of record must be kept accurately. It must be well kept and must be done accurately. It must be transparent. Because they're going to give account on health. That's going to give account to God too of your stewardship. So what's the importance of keeping record and accounting? Number one, for profitability purpose. For profitability, we need to know if you have a business, you have a small business. Let not go further and saying about those conglomerates businesses. You have your own business. You're starting our own clothing line, or you're starting your own little business, or maybe provision, selling provision. You need to keep record to know if you're making profit or not. It's very important. It's critical that you keep record to know, are you making profit or not? This is the decision we now have to make after the end of everything. Am I making profit? Do I need to continue? Do I need to still progress in continue this business and everything? So you have your keeping of record will make you know if you are making profits or you're not making profit or you're just at par. So for profitability purpose, and it makes you know how much you are making. How much are you making? That's the reason for keeping record. You can imagine a country, a business that's not keeping records, then it's going to collapse. It's going to die. It will die because you're not keeping records. So you don't know how you have been spending. You don't know, you just go ahead to spend money on something that you're not meant to spend money. And when you keep money, it controls you. It makes you know that you cannot go further than this. If I go for it will affect my business. For example, you sell a recharge card and you're selling card on credit to everyone. And how much profit do you make in such card? And you're selling the recharge card to everyone and you're not keeping record. You don't know you've reached a limit to which that you cannot sell card on credit again. It will definitely affect your business. You need to know how much am I making? They are making so much more, you know what to. That's when you know the decision you have to make for decision making. You need to make decisions, informed decisions, business decisions, and everything. An organization or a business that keep records, keep accurate record, has the potential of growing. Businesses, we now see this, they are now big. They started from scratch, they started from small, and I'm sure they kept record and they begin to look at the record and they see that I'm making profit. So this part of this profit, let's plow it back into the business to make sure that it progresses. Let's expand, let's diversify. So for business, so to make for decision making also, keep record for decision making also. And also to ascertain your financial position, to know the position, the state where you have your business. At this social time, as of December 31st, 2023, the position of my business is this. The position of my business is this. So in 2024, I should be able to do this. So you ascertain the financial position. You make you know it's like a picture. It's like a picture. And that will be very clear in your balance sheet. Also makes you plan. You plan. You plan. You plan. You plan. You plan. Dangote too also plan. And you know, as you see, he has sugar, he has salt, he has cement and everything. And they will now, I know, at the top level management, let's also go ahead and look at what they need, what is needed in the country. So what did he do? Also diversify again, went into producing of petrol, planning, and before you know, it's expanding, and it become the richest man, the richest man in Africa, the richest black man in Africa, because all these are followed, planning, everything. Be able to ascertain your assets and your liability. We get to aspect where we talk about assets, and I believe you all know what asset means, but we still get there. Ascertain your assets. You also know your liability, who you are obligated to financially, the loans you've gotten, the starting of business, you know, those who you need to pay, the asset, what you have, and everything, your land, your building, your car, your furniture and fitting, right? State the position where you are at that time. And you can see that happening in our country whereby we start doing all those fraudulent acts. Starting all those fraudulent acts. Please, if you are still together, please, from the chat room, let me know. From the chat room, let me know, please, if you are still together. So not be just I'm only the one just going ahead. In the chat room, let me know if we are still together. Or you can unmute and say I'm with you. So I know. Hey, hi, okay. Okay, Mr. Sonny. Hey, hi, will be more productive and efficient. So thank you. So okay, thank you. I'm with you. Thank you, Abel. Within thank you. So thank you. So these are the important, we prevent fraud too. We can see what is happening in our country. Fraud is so rampant that the way they do it, but if they are accurate record keeping, it will prevent fraud. So it's better to prevent it than allowing it. Prevention is better than cure. Prevent it from happening than allowing it and now start looking for the remedy. To prevent fraud when you keep record, you know where this money goes and where that money goes. So to monitor the progress of the organization, which is very important, you monitor the progress. Am I growing? Am I static? Am I retrogressing? Am I progressing? You need to know that. You need to know that. So these are the reasons important for bookkeeping and accounting, and making economic comparison. So within the same industry, you want to know your state. What are you within your own industry? If the bank try to compare record, is my bank making as much as this bank is making? It is in the manufacturing sector. Is my company making as much as this company is making? These are things you need because of this record to be able to compare, to know where you stand, to know if you are doing well or not. So these are the importance of keeping the record. I hope I'm clear. These are the importance of keeping records. These are the importance of keeping records. And with that too, before I even move to the accounting equation, the role of an accountant, it's very important that we also look at the role of an accountant, also the role of an accountant. So what are their roles? What are their functions? Who is an accountant? Who is an accountant? So we need to know their roles in the organization, in the business sector, even in the world, in the country rather, our roles. So they play a major role. They play a vital role in the development of an organization and even as a country, So as you know that an accountant is a person that is responsible for the preparation, is the one that is responsible for the preparation and then analyzing and interpreting the financial statement that we talked about. So, and its function is to keeping of records. Keeping of record. That's one of these functions. You must keep record and trying to look at other ones. So you see, keeping of record, protecting shareholders' funds also there. Protecting shareholders' funds is very, very important to also. Trying to get that to be able to see the roles they play. So recording transactions, I have said, track records and everything. You prepare financial statements. An accountant that will prepare the financial statement also. They do budgeting and forecasting. You do your budget, you forecast. From the financial statement you make, you're able to forecast. You're able to forecast. And that's when it comes to the shares and everything. When you go ahead to meet those financial analysts, they will tell you, don't invest in these social company shares. Invest in these shares, it's going to increase. Don't invest in this, it's going to crash. They tell you those things. They forecast too. And they do auditing, the auditors to their accountants. So this is another line of another accounting discipline. So auditors are there to audit, to check, to do check and balances to see if it complies with the rules and regulations, the practices, the concepts of accounting. They do that. And also they do tax planning and compliance, the tax law, they make sure that all these things are complied with. So all the tax you have to pay, the CIT, that's the company income tax, the VAT and everything, they do that also. But they also analyze financial analysis, they make financial analysis also. So they analyze financial data to provide insight into financial health of the company. They look at it, they analyze it, they tell you. They are like a doctor that look at the statement, or when they see the statement of faith, they will tell you the position of your business. The position of it. They are just like a doctor too. As a doctor would diagnose you too. So an accountant also would diagnose from the books of accounts, from the financial statements, the records. You need to diagnose what is going on with your business. What is going on with your business. And also internal controls too. Also, the accountant help in establish and maintaining internal control system. You safeguard the assets you have, make sure everything is safeguarded and everything. Management accounting too. They also do financial advisories. Also, these are roles of accountant. These are roles of accountants. These are roles of accountants. These are roles of accountants. Now, let me now ask you this question. Who will govern the state or the country more? Is it an accountant or a lawyer? In our country, our states is governed by rules. Our constitution, we abide by the rules and constitution. So who do you think needs to govern the country or the state more? An accountant or a lawyer? Let me know. Yes, in the chat room and say, let me know. An accountant. Both. No, let me know. Yes, Mamdi said both. Yes, and yes, both. But who do you think will enjoy more? Who the dividends of democracy? An accountant will need to govern the state or the country well, or a lawyer in case study in Nigeria. Let's look at case study in Nigeria. Okay, Dr. Launa said an accountant. Okay, an accountant. Is it because we are studying accounting that you're all saying accountant? Okay, why do you say it's an accountant? Why do you say it's an accountant? Well, happily, there are accounting laws, so I believe it's an accountant. Okay, yeah. So if you are saying an accountant, why is it not a lawyer? Because there is a constitution that we need to follow. So why is it not a lawyer? Why is it an accountant? Why is it an accountant? Do you think it was an accountant that is ruling us, the country would have been better than where we are now? Or it was a lawyer? And looking at some of our governors, in Dumani was is an engineer. You saw what he did at which one? I think Enugu or thereabout his state thereabout. So and they made him minister for works because of what he did. He's an engineer. And we have lawyer Baba Tunde Fashola was a lawyer and saw what he did also. We have who do we have another accountant also too? I think only our most think is an accountant. Even our president is an accountant. So if you compare who has done great, or is it about their discipline, or is it about their character, their personal character, how they were developed? So, so, so they predict, they check, and they balance audit. Okay, good. So as you all know that, as we nurturing up into this accounting aspect, when you go into your field, you need to know what to do. An accountant. Accountant is not there to go and defraud. Accountant is there to make sure everything, all checks and balances, to check and balance everything. To check and balance everything. That's the work of an accountant. Go there to make sure that everything is done well in the right way. There's no fraud, and you prevent fraud also. These are the work of an accountant. So don't let them see accountant as someone who will just go there and start squandering money. Before you know, when they come for probe, they tell you snakes swallow this, monkey swallow this and that. It shouldn't be. You should be able to check it. And a case study of this present, our 2024 application bill. I don't know if any one of us has seen the budget. And you see humongous allocation to some things that you starting, wow, what on earth? How did this come about? How do we get here? How do we get here? So let's move on because of our time. So let's now look at the accounting itself, accounting equations. These are the fundamental framework of accounting. It is very important. The accounting equation, the classification of accounting. We have the assets, we have the capital, and we have the liability. We have the asset, capital, and the liability. In accounting, you find the framework of the entire financial accounting process. That's the equation. So asset is equal to capital plus liability. Asset is equal to capital plus liability. So as I said before earlier on, what is asset? So these are the properties you have, your land, building, your plant and machinery, your motor vehicle, your furniture and fitting, the cash you have at hand, the bank for cash equivalent, you have that your shares and everything. These are your assets. These are your assets. And you get all those assets through your capital. That is the money you provided by yourself to invest into that business. To invest into that business. And liability is the money you borrow outside that, lend to. So to start the business, for starting a business, Dangote started this or the refinery. He has his own money that he put there, and he also borrowed also. He also borrowed also. So asset equals capital plus liability. Asset equals capital plus liability. So if you turn things around, if you want to get your capital, that means it will be, if you want to turn it around, how do you get your capital? Just the mathematical equation. That means you will say, for you to know the amount of capital, it will be asset minus liability. I hope you understand. Asset is your capital, the money you put into the business, you plan the business, plus the money you borrowed from people that you plan the business. Everything together makes up your assets. Makes up your asset. So if you want to get your capital, this will be your asset, the whole thing that makes up your asset, minus the money you got from outside, you borrowed from outside that. That will make your capital. And if you want to get your liability, it will be what? Asset minus capital. So these are this is an accounting equation. You should know that. You should know that. This is your left hand or at the back of your head. So you know that. So also, Okay, which is the accounting. We talked about the role of an accountant. We talked about that at that time. We talked about that. So the management account, the internal controls, and everything. We talked about this. So then we're moving to the principles of accounting. The principles of accounting. As you all know, you must have been hearing principle. When you say this man, okay, then yes, it will be. It will be. So as you know, when you say this man is a man of principle, it means this man, no matter what happens, nothing, no matter come rain, come shine, he sticks. This is who he is. This is who he is. He's a principled man. He's a principled man. It will not. There's no element of bias or sentiment. It's the same thing will have the principles of account. Principles of account. These are the things. These are the things we need to follow. These are the concepts. These are the structure that make accounts that make accounts to stand firm. These are the things we need to follow as an accountant. These are the things we need to follow, irrespective of where you are, either here, even as long when they take your financial statement, if you send it to another country, far east, eastern part, it's the same thing they practice there. They need to understand the same thing. So as I've said that, it's also called GAP, generally accepted accounting principles, generally accepted. It is accepted all over. That's why we created that body. That body was created by International Financial Reporting Standard. So these are the things, the standard we follow. So they regulate, so they set standard guidelines and rules that govern accounting and reporting. It's one rules and reporting. So, and why this principle is just to ensure consistency, to ensure transparency, to ensure comparability. You can compare financial statement from one country to the other and everything. So if a man from the middle belt or from anywhere see your financial report, he will understand because he knows there are principles guiding it. Just like if you build a house, there must be the number of cement that should be there. There must be a quantity of cement, the sand that must be there, and a grinder that needs to be there. There must be reinforcement. There must be iron. It has to be there if you want to build. All these things. The same thing applies to accounting too. The principles has to be followed. It has to be followed. What are the principles? What are the principles? One, Accrual principle. We'll be talking about accrual and cash principle. So for accrual, this talks about you make your record immediately. You record, I'm trying to make it in a simple way. Immediately you make that sale, or immediately you won that contract, and you won it, and you've done it. You record it, irrespective if you have been paid or not. That is the accrual principle. Make the record. Revenue is recorded when it is earned. You earn it. They've given you your award letter that you earn it. See, so you earn this also contract. Is that. It's already, even though you've not received the payment, but you've earned it. That's what accrual is saying. But cash is not saying that. Cash principle is only telling you that you only put in your record into your books of account when the cash has been received. When the cash has been received, that is what cash principle is talking about. Accrual principle is telling you that revenue is recorded when not necessarily when cash has been recorded. You when you receive the cash. When you have received the cash, when you receive the cash, that is what cash basis will tell you. That's what cash basis will tell you. It's just like Thomas, seeing is believing. That's what cash is saying. Give it to me, let me see, and I'll record it. Aqua will tell you, in as much you've told me that this is what it is, I'm going to record it. I know you are going to pay me back later. The same that's for revenue. The same thing applies to the expenses too. So expenses is recognized when it is incurred, but not necessarily when cash is paid. Sometimes it does. For example, your postpaid, your postpaid, your IPEDC, your meter and everything, you are using postpaid and everything. You've already incurred the expenses, but you've not paid, or you write it down. But under cash principle, it's telling you that it is when you have now made payment for the expenses. It's when you are making payment for the expenses, then you put it on record. So you see the difference between the accrual basis and the cash basis. But the principle an organization follow is the accrual basis. The principle every business follow for comparison, for consistency, it is what they follow accrual principle. But in government, it could be because of the volume of money that is attached to it. So it's only talking about their own is cash principle. They don't record it that we can this. Even if they get grant from one government or one foreign government, if the money has not come in, they don't put it on record. Even from their own revenue too. If the money has not come, even though they know that this money is going to come in. So if the money has not come in, they don't put it on record. So the principle government follow is cash principle. While all other organizations, private companies, limited companies, they follow accrual principle. So number two, conservatism or prudent principle. Prudent principle. So this will suggest that when faced with uncertainty, that means an accountant must not overestimate, must not overstate. As I always say, don't count your egg. Don't count your chicken until they are hatched. Don't say because you have 10 eggs, and I know those 10 eggs they will turn to chicken. They will turn to chicken at the end of the day. They will turn to chicken. No, you have to be prudent. You don't overestimate. You don't overestimate gain. You have to be prudent in it. You have to be conservative. Don't overestimate it. You have to lean towards being conservative. That is it. And also you anticipate, there might be loss. You don't know what will happen. There might be loss. So you make provision for that. You anticipate for it. That's the work of an accountant. You don't just overestimate. And also overestimate gain. And also underestimate loss, potential loss. You have to be prudent in what you are doing. Consistency principle. That means the method you're following, it must be the method you are following every time in a consistent manner. The method you follow this year must be the same method you follow next year. Must be the same method. So that's the consistency principle. You must follow it. Similar transactions are treated in the same manner, in the same way, from one accounting period to another and everything. So you'll be able to compare last year with next year, this year with last year. So when there is consistency. Then number 4, materiality concepts. Materiality concept. This is relative. This is relative. It depends on the business. It depends how big the business is. How big. So what you count as material might be immaterial to me. So it depends. So only items of material value or significant impact that will be recorded. That will be recorded. Some people in a very small business, stapler will be an asset to them. Whereas to another company, imagine, let's say a company, in case for the Dangote, if they buy a stapler, do you think do you think it will be a material value to them? No, because it's just too small. It will just put it on the expenses. Why a very a business center who just has one laptop and one printer, just starting business, will give you material value. It's also materialistic before the business. So material principle. So only items of material value or similarly impact the financial decision should be recorded. You can record it, it will be recorded, but if it's not of material value, you just expenses straight. You just expenses, just put it on the expenses instantly. So objectivity principle. So this to tell you that as an accountant, you have to be objective. You have to be fair. If you not look at it like it's your sister, is your brother, and I have to hide my not see all of that words, or you have to be too sensational. The objective is straight. Don't be biased. Don't be sentimental. Don't be sentimental. Say it as it is. Say it as it is. What you see in this, and this is what I discovered. Say the objective. You have to be objective. Even if it is your daddy's business, say it as it is. You have to be objective. Then going concern number 6. So it's always assumed that business should continue to exist to numbers of years. Nobody is planning to start business and the business will just go and everything. So it is, you assume that you're starting the business, you want to be there forever and ever and continue to expand till Jesus Christ comes, till rapture comes and everything. So going concern, assume that the entity, the business will remain in business for a foreseeable future. For a possible future, you continue to do your business. That's going concern principle talking about matching concepts. Number 7. So expenses should be matched with revenue. The expenses you make for that year, the revenue you earn for that year should be matched with the expenses for that year. The revenue you earn for this particular sales, the expenses you incur for that same particular sales should be matched together. The revenue you earn from this particular project, the expenses you incur for that project should be matched together. You cannot take someone else's expenses and match it with another different revenue. So it's going against the principle of matching concept. So expenses should be matched with revenue. The one that you generated during that same accounting year. That's the accounting year. That's the main purpose, reason why you earn those revenue. The expenses you incurred must be matched together. It must be matched together. And that should be accurate and it has to be calculated very well. So full disclosure principle. So the financial statement should be disclosed to disclose all necessary information that might influence the decision of the financial statement. So you must not hide anything. You must disclose everything. You must disclose everything. So when they see it, it must be transparent. When they see it, they can make decisions. They can make business or financial decisions, informed decisions as regards it. But whereby in a situation whereby you refuse to disclose some vital information, you are misleading the public. You are misleading the shareholders. You are misleading the stakeholders. You're misleading them. And risk will run into a huge financial loss for them. But when you disclose it fully and they see it, it is now like buyers beware. As they always say, beware. You've seen this thing, make your decision. Do you still want to go into it or do you want to step back? So you make full disclosure. You make full disclosure. And we have the money measurement principles too. So this transaction which can be expressed in monetary terms are recorded. Or transaction that can be recorded in monetary terms, that's what you record. You can measure in monetary terms, you record. When it comes to money, that's what you record. But when it comes to like bad management or misconduct of the employee, how do you monetize that? How do you transform that into money? So you can't record that into, you can only put that one at the note in a separate way. So you don't see that the misconduct of an employee and one employee did something bad, maybe come to office late and everything, seen it in financial statement. No. Financial statement has no business to do with that or bad management. But it's just that their heart will always reflect in the financial position of the country, of the company. Or writing it down there, misconduct of employee or bad management, you don't record that. You don't record that. Then the cost principle. So are you with me? Let me know if you are with me. If you are still with me, just type 1. Let me know if you're with me. Just type 1. If you are following, just type 1 from chat box. So I know that yes, we are together. You know, we are together. Just type one if you are with me. Yes, thank you, James. Yes, good. So, yes, you know, thank you, Salma. Thank you. Thank you, Doctor. Thank you. So, cost principle also. So, assets should be recorded at their original cost. When it comes to balance sheets, we'll be talking about that in our next class and everything. So, assets should be recorded at their original cost, not their current market value. Not their current market value. That's the principle. That's cost principle for you. The original cost, the amount you bought it, you record it. Not saying, and this amount, this thing, I bought it this amount, but the current value is now this amount because of the inflation and the economy and what is going on in the country. Let me just boom, push it up. No, it must be recorded at the original cost you bought it. That's what it is. Business entity principle. This concept stated from its owner. Businesses should be separated from its owner. Businesses should be separated from it. Business, excuse me. Business is an entity on its own. That's why we differentiate it from it. We have the limited. You go to government, they give you certificate, you have a CAC because it's not separated from your own. Except all those small businesses that somebody, a woman selling body at the road junction, you cannot separate that body owner from a business. Or somebody selling pure water, hawking pure water, you cannot separate that. You cannot separate that. These are small petty businesses which you cannot separate that. But normal standard business is a business on its own. So you have to be separated from the owner. You have to be separated from the owner. So if the money is used, if the money in the business, if it is used to pay the owner's expenses, just know that the owner has to pay it back. The owner has to pay it back. So you cannot say, because it's my business, start spending it anyhow. Start spending it anyhow. So you just don't go ahead and just treat it just like that. You have to be recorded, treat it as drawing, as drawing, child as drawing in the books of record, in the books of accounts. So business is separated from its own. That's why I have the limited, we have every company when you see limited. This is so Ade and Shegun and Co Limited. This PLC, GTB PLC is separated from the owner. This and that. You so you are saying the limited or PLC, they are separated from the owner. Periodic principle is financial performance of companies. It should be divided into periods. It should be divided into periods. I will ask, if you've seen financial statements, into what period? What period is it divided into? Into what period? Let me know from the chat room. Let me know from the chat room. Periodic principle, periodicity principle. The financial statement you've seen it, is a statement of how many months or how many years when you see it. When you see it, it is what from your chat box. Let me know. It will be interactive, so it will not be like the one talking. It won't be like I'm the only one talking. Yes. Periodicity principle is divided into period. So into what period do you see? How many months do you see the financial statement? Nobody's talking? No. Nobody's saying anything. I'm waiting. Yes. 6 months. 6 months. It's always 1 year. I say, except maybe the company starts maybe half of the year, started business maybe from the middle of the year to now. Most of the financial statements we see is always from January to December, 12 months. After doing that, we make the same. Then the following year again, we start another one again. So it's 1 year, that's 12 months. 12 months. So when you're making your financial statements, it's always going to be. That does not nullify you making your monthly reports or your quarterly reports or your 6-month report, which could be used for management purposes. But the 1 year, which the tax authority will use or the government will use, which we also use to compare from one industry to other, it has to be 1 year. It has to be 1 year. So then the dual aspect principle. Dual aspect principle. So we say that there are 2 aspects of accounting. We're going to talk about that when we talk about the principle of double entry. Principle of double entry. There are always 2 sides to account. You have the debit side and the credit side. We talk extensively on that. The debit side and the credit side. So we always have the dual aspect principle. So all these principles, they form the foundation of accounting practices. These are the foundation, as I've said. They form the foundation of accounting practices. Be it wherever you are, these are the foundation. Anywhere. Anybody that does not follow this principle or shortfalls from it, then means the financial statement is not transparent with anything. It's not transparent with anything. No. But there's something in that financial statement which cannot be used, which decisions cannot be made. So it provides framework for preparing and interpreting financial statements. So complying to all these principles, it helps us maintain consistency. There will be accuracy. There will be reliability also in our financial reporting, whereby the investors can look at it and make their decisions. The shareholders too can see to know what is their benefit, the dividend that's being earmarked to them. So and the regulatory bodies to know the tax they need to collect. You need to charge next in the financial statement. These are the principles. So these are the principles. So now let's now move to the principle, moving into accounting proper. Moving into accounting proper. And as I told you from the history of accounting, as it was evolving, these Italian monk, Lucas Pasuli, brought about double entry principle. And it has been a bedrock for accounting. It has been a bedrock for accounting. So I will need you to pay more attention to this. I will need you to pay more attention to this. It says, double entry system is the entry of debit and credit. It's the entry of debit and credit for each transaction. For each transaction, there must always be debit and credit. So there's a rule for it. You debit the receiver and you credit the giver. You debit the receiver and you credit the giver. So I'll have loved you say after me, but I will not be able to hear you. Debit, receiver, credit, giver. You just say it. I know from my instinct, if I close my eyes, I will know those who are talking. Debit, the receiver, and credit, the giver. So this, as a principle, we'll talk more on that too. So debit, the receiver, and credit, the giver. So, and next slide. The golden rules of double entry. The golden rules of double entry. Please take a look at this. Take a look at this golden rules of double entry. Digest it. Take a look at this golden rules of double entry. Golden rules of double entry. All transactions must be recorded in 2 accounts. All transactions, each transaction you make must be recorded in 2 accounts. You must create an account for in 2 accounts, not 3, but 2 accounts. One account is debited and another is credited. One account is debited and another is credited. That's one of the golden rules of double principle of double. One account, there must be a corresponding credit entry in another account. I'm going to give an example so you understand this. For every debit entry in one account, there must be a corresponding credit entry in another account. For one account that is saying take, there's another account that is saying give it to me. That's how we just look at it. For now, one account that is saying, oh yeah, take this. And there's another account that is stretching his hand that, okay, give it to me. So for every debit entry, there must be a corresponding credit entry. And the third one, that's vice versa. For every credit entry, there must be a corresponding debit entry in another account. There must be a corresponding credit entry in another account. I hope that is clear. Please, if it's clear, can you just type in the chat box too? In the chat box too, if it is clear. If it is clear, if you still want me to just take a step back to explain it further, but we're still going to go into practical of it to understand. But for that coding rules, I hope you understand that. I hope it's clear too. If you understand it, then start on the chat box too. If you understand it, that type two, if you understand it. So the process of applying double entries. The process of applying double entry rules. Number one, identify the two accounts that will be involved. You need to identify the two accounts involved in that transaction. So from that golden rules, when we say two accounts should be involved, will be involved. And for every debit entry, there must be a corresponding credit entry and vice versa. So what are the things you need to know? Identify the two accounts involved in this transaction. If you are still with me, please, can you just type something? Let me know if we are together. Let me know if we are together. Let me know if we are together. So let me know. Let me know if we are together. If you okay, James, we are together. Yes, Salmo, thank you. James, thank you. Yes, we are together. So let's now move to the golden rules, how we can, yes, thank you, Bamdele. Yes, thank you, yes. So to just know that, yes, we are together. Process of applying the double entry rule. Know the two accounts involved. You must know the two accounts involved. So determine the account that gives value and the one that is receiving value. That means determine the account that is saying take and determine the account that is receiving it. When you determine that, then what should you do? Debit the one that is receiving, credit the one that is taking. Credit the one that is giving out. Credit the one that is giving out. So listen, credit the one that is giving out and debit the one that is receiving. So debit the receiver and credit the giver. So debit the receiver, sorry, I typed it 2 times, debit the receiver and credit the giver with the value involved, with the amount involved. 4, debit any receipt and credit any payment. This is another golden rule. Debit any receipt and credit any payment. And 5, debit value in and credit value out. Debit value in and credit value out. Now, let's give an example now. Let's give it. January 6th, you started business with 100,000. You started business with 100,000 naira. Number one, you say you have to know the two accounts involved. You've got to know the two accounts involved. What are the two accounts involved? From here, as you can see, we have bank and we have capital. We call it capital because we are starting a business. So the business we're starting, we call it capital. That is the two accounts involved. Bank, capital. You started business with 100,000 naira in bank. The two accounts is now bank and capital. So from this now, who is giving out and who is taking in? Who is giving out and who is taking in? From the golden rule, they say identify two accounts. first account, the two accounts is now the capital because you are starting business with 100,000. You're starting business with 100,000. So the two accounts is capital and bank. So starting business with 100,000 in bank. So that's that two account. The second one says determine the account that gives value and the one that receives value. Same thing, so debit the receiver and credit the giver. Now, from this, who is giving out? We have capital and we have bank. Who is giving out? Credit the one that is giving out, which is capital. That's the account. Capital account. What value? 100,000. Who is taking in? The bank. You're starting the business with 100,000, you put this in the bank. The bank is taking it. Then you debit your bank with the same amount. So for every debit entry to an account, there must always be a corresponding credit entry. January 7. January 7. From that same money, you took to the bank. Now 100,000 you took to the bank, and it's in your bank account. Okay, sorry, this is saying you now bank cash. You went to the bank, you took 20,000 naira to bank. That's what it's saying. Sorry. Yes. You took 20,000 naira to the bank. Two accounts is involved here also too. That is the bank and cash. Bank and cash. Bank and cash. Who is giving out? Cash is giving out 20,000. And who is taking it? Bank is taking it. So that's why I have debit bank account, because it's going, 20,000 is going to the bank, debit it, and credit your cash because cash is going out. Because cash is going out. Please note this, the principle of double entry. So we have more examples too again. Shegun lent us 50,000 naira in cash. Shegun lent us 50,000 naira in cash. Two accounts involved. We have cash because it said in cash. If it was in check, that would be bank. Shegun lent us 50,000 naira in cash. So we have Shegun and we have cash. That's the two accounts involved. Which account is giving out? Shegun. You credit Shegun. And it's a loan because it's lending us. It's a loan. So 50,000 is lending us 50,000 naira. It's loaning us 50,000, right? 50,000. And debit cash because it's coming in. Cash account is the one receiving it. So you debit cash account with 50,000 naira. So move further because of time. Cash purchases too. Cash purchases. That means you purchase some goods in cash. You use cash to purchase some goods. Two accounts is involved here. You have the cash and you have the purchases. You have the cash, you have the purchases. Cash is giving out and purchases is coming in. Cash is giving out and purchases is coming in. Cash is giving out and purchases is coming in. You have it there. Sold goods to caller on credit. Sold goods. You sold goods to caller on credit 30,000 naira. Two accounts will be involved here. When it comes to sold, we are talking about sales. When it comes to sold, when it comes to talking about sales, when we talk about bought, we are talking about purchases. When we talk about started business, we are talking about capital. Sold goods to caller on credit. Sales and the second account, caller. Caller. But if it was not on credit, maybe so good cash. It would have just been cash. But because it was not cash, it was on credit. So you have to put the name of that person, the name of who is owing us, caller. So sales is giving out and caller is taking in. Sales is going out, that is credit sales with the amount 30,000 and caller, debit caller with the same 30,000 naira. So as you can see, also bought furniture. Bought furniture for cash, 45,000 naira. You bought furniture for cash. So two accounts are also involved here. Furniture and cash. Furniture and cash. Furniture is coming, but you bought it. You bought furniture. So furniture is taking, the account of furniture is taking in. So credit, you debit the furniture account with 45,000 naira, and then you credit cash because cash is going out. but its cash is going out. But it's the same thing on January 10 to you withdraw cash from bank for private use. You withdraw cash from bank for private use. So because for private use, so you have your withdrawal account and you have your bank. You have your bank account because it's taken from bank and you're using it for private use. So you have your withdrawal account, which is 15,000 naira, which you have to do. Then also if you look at the rest and everything, 24th January paid Elizade by check. So okay, let's look at 20. They said purchase motor vehicle from on credit. Purchase motor vehicle on credit from Elizade. Purchase motor vehicle on credit from Elizade. So you have two accounts involved: motor vehicle because it's an asset, and Elizade because we bought it on credit. It was cash now. You would have just put cash there, but it was on credit. So motor vehicle account, you debit motor vehicle because you purchase motor vehicle, and you credit Elizade. Now for 24th, now paid Elizade by check. What are the two accounts involved? Please, I would like to know from the chat box. What will be the two accounts, and which accounts will be debited and which accounts will be credited. I'm waiting because of our time. Then fast. Which account will be debited and which account will be credited? Which account will be debited and which account will be credited? Someone just in the chat room just indicate. Anybody? So when we talk about check, we're talking about bank. Yes, so we're talking about. Remember, you are something is going out. The money in your bank is going out because you paid. You bought a vehicle then, but you are now paying. You're now paying back. You are paying it back. So you cannot credit Elizade again. Because if you look at the first one, that is why I put that 20th. You bought the vehicle from Elizade, you've not made payments. Because you've not made payments, but the vehicle has come in, you debit your vehicle, but you credit Elizade. Now you've made payments, it has to be reversed. Two accounts involved, one is Elizade and bank, because you will not just put check, because you are taking the check to bank. Elizade and bank. So what is going out? The bank is going out, giving out the money you used to purchase that vehicle, taking it to Elizade. So if it's going out, what does it mean? You have to credit your bank and debit Elizade. That means with the value of that vehicle, the vehicle is 100,000. So you credit your bank because you've now paid. So the money will go out from your bank and go straight to Elizade. It will go straight to Elizade. So that we need to be very familiar with this. We need to know it. We need to learn this accounting principle very well. We need to learn this accounting principle very well. It's very, very important to do that. We need to learn it very well. It helps. This is the foundation. Okay, what about this paid salary in cash? You can see paid salary. The two accounts involved is salary and cash. Salary is taken in because you pay the cash. You paid cash. Cash is going out. Cash is given out. Salary is taken in. Cash is going out. The salary is taken in. So it is pay salary by check. Bank will be going out. Salary will be coming in. So you credit your cash or you credit your bank if it's check, then you debit your salary because that account will increase. This is that account that is receiving the value. That account that is receiving the money. So So double entry rules can also be applied in this way. So let's look at these rules too. So debit asset account when there is an increase in value, and credit it when there is decrease in value. Anything that involves assets, that's your motor vehicle, your land and building, your plant and machinery, furniture and fitting, when there is an increase. Debit asset account when there is an increase. When there is increase, you debit the account. These are principles, these are rules. Debit it when they are increasing. When you are buying more, you debit it. But when they are reducing, maybe you sold some or some got obsolete or some got spoiled, you do what? You credit it. When it is reducing in value, you credit it. As it's coming in, you debit it, and you debit it. So the corresponding debit entry, the credit entry will now be either the cash you use to pay it. So, and when it's now reducing to, you credit it to nil it, for you to know the value, for you to now know the net value, to know the balance on that asset. And also debit expenses account when there is an increase. All the expense account, the light and bill, transportation, all those expenses you make. When there's increase, you debit it, and when there's decrease, you credit it. Same thing also applies to credit liabilities, your loan, your overdraft, those loans, your creditors. So when you credit liability and capital, your capital too, when there is increase, or you debit when there is decrease. You debit when there is decrease. So know all those rules. So classification of accounts also. So account is classified into personal accounts, classified into personal accounts, and the impersonal account. Classified into personal account and impersonal accounts. So when we talk about personal accounts, we'll be talking about the debtor, the creditor, the individual, the firm, the corporate. That's account, that ledger that deals with person, Shegun, Tokwe, Kayode, all those personal accounts. So that's the account to open, most especially when it comes to the fact that they've not made their payment based on a prior basis. You put their name there. If it's a company that's owing you, put the name of the company there. Or if you are owing a company, you are owing somebody, so you put the name of that person there. So that's why I have the creditor, debtor, individual, claims, etc., which is called the personal account. Why the personal account is another ledger that deals with the revenue, expenses, the assets, the revenue, the expenses, and everything. So, and that one is now divided into the real and the nominal. The real are the assets. The real are the assets. That's the motor vehicles, the land and building, furniture and fitting, the store, the prices are the real. While the nominal are the gain, the loss, the income, the expenses from that. So personal and personal account, and that personal account is the real, the assets, and the nominal. What those you find in your statement of profit and loss account, the expenses, the day-to-day activity of the business. Day-to-day activity of the business. That's what you have to do nominal. So now let's move into capital and revenue item. Capital and revenue items. You have a lot more to cover up. You have a whole lot to cover up. Capital and revenue item. From that word capital and from the word revenue, and this apply more to governments. You've been hearing capital project. What's the problem of this country? What what problem do we have as a country? Is it the expenditure aspect of it, or the capital? I'm still going to come to that, but okay. Capital items. What are capital items? These are long-term asset or investment. These are capital items. So anything that they are long-term, all those assets that are long-term, your investments, your land and buildings, these are capital items. So what do you mean by capital items? As you can see here, this refers to long-term asset or investment that the company purchase or invest in to generate income. You invest in that thing to generate income. For example, woman at the bus stop selling boli. What is she going to buy? She's going to get stool to sit on. To her, that stool is a capital item to her because she will need an umbrella. Come rain, come sun, to protect herself from the ray of the sun or from rain. To her, that's a capital item. She will need this round net. Also, she will need this round net and those things. That will use for a long time. At least she will use the stove for at least more than 1 year. You cannot pay if she knows how to maintain things at least for a long period of time. She will use for a long period of time. So these items are not meant for immediate consumption. It's not meant for consumption. It's not meant for consumption. But I expected to provide benefits for a long time. Provide benefit. We bought it for you to earn more on it. To earn more. An Uber driver, the car, what will it be? Will the car be a capital item or a revenue item? When we have that, it is refers to a long-term asset or investment that a company purchased to invest in generating income. So, an Uber driver, what will the car? Will the car be a capital item or a revenue item? Yes, from the call. From the chat, Uber driver, the car, will it be a capital item or a revenue item? Yes. Can you please just type in? I need as much as yes, yes, capital item. Good. Yeah, capital. It's going to be capital item. That car would be capital item. So as you've seen, capital item. Thank you. They are capital items. Thank you. So capital items contribute to the company's long-term growth and productivity and does not appear in statement of profit and loss. Yes, those things. When we get there, we will still get to that aspect. It does not appear in the profit and loss account, but only appear in their balance sheet. So because an Uber driver will not put in this also year, the first year, now put I bought vehicle. Anyway, we get there. Don't let me complicate things for now. Don't let me complicate it. So examples of capital items: acquisition of land, building, machinery and equipment, improvement of assets in order to add value. When you improve an asset to add value, maybe it's almost maybe running that fault, then you improve on that asset, you refurbish it and everything. Increase of the earnings of capital of the business that intangible assets such as patent, copyright, trademarks, and brand names. These are capital items. Now, revenue item. So I'll still use the example of this the boli woman and the Uber. So from the definition of revenue item now, as you can see, that these are the day-to-day expenses. The day-to-day. It's not one-off. Car would be one-off, but these are day-to-day expenses or income generated by business regular operation. So they are typically related to the company's ongoing activity. For an Uber driver, petrol, will it be a capital item or a revenue item? It's going to fuel his car. The fuel, is it a capital item or revenue item? Remember, these are day-to-day activity. Thank you, Zainab. The day-to-day activity. So you can see they are day-to-day indicator. Yes. Thank you. They are revenue items. So unlike capital items, revenue items are consumed or utilized within a short period and contribute to the company's immediate financial performance. You can see. So when you have the sales revenue, the maintenance, you do the repair, you do an expenditure on a day-to-day expenditure, the NEPA bill, the utility bill, the LOMA, on a monthly basis, the normal you pay on a monthly basis, the ballet you pay on a monthly basis, on everything, salaries, the wages, office supplies, you bought so stationaries and everything. These are revenue items, operational items. So you can now see the difference between capital items and revenue items. Capital items and revenue items. So looking at the country, if you look at our budget, if you always pay close to news and you hear about our budgets, they will tell you, okay, this is so year at least for 2024. You know that the budget for 2024 is 27.6, I think 27.6 trillion. 27.6 trillion, and it can be divided into capital and revenue. It will be divided into capital and revenue. And capital we're talking about is the roads, the purchase of maybe roads or big machineries that you see, or building of bridges, building of schools, and that will be under capital. And when you now begin to see salaries and you see salaries, you see DTA, that's duty allowance, store allowances, all these things, they are revenue. But normally, every country wants the capital item to be more than the revenue, because we said capital item will always generate more income. And this is the problem we're having as a country, because we tend to spend more. We go to the extent of even borrowing to pay for revenue items. If you are borrowing to pay for salary, how do you expect the money to come back? But you are borrowing to build schools, to build roads, whereby there will be development in that country, in that locality, where business progress, then collect tax on that place, then money comes back. You build bridges, when you put toll gates, the money comes back. All these things, money comes in when it comes to capital. But we tend to spend more on revenue items. And that is the problem we're having as a country. And what do we result to? Borrowing. So you're borrowing, the budget is 27.6, and the expenditure budget. For the revenue, how are we going to generate the 27.6? The only way we can we can only generate 18 trillion out of the 27. We can only generate 18 trillion. What about the shortfall, the 9 trillion? How do we get it in order to be able to meet up with the budget? Borrowing. That's when China comes in. That is where all these IMF comes in, and they don't do things for free, selling us, as I always say. So you need to know all these things, so you need to understand what's going on. You won't be aloof of what's going on in the country. When you see all these things, you know, no, this what this country, this government is doing is wrong. It's not right. You need to know all these things. So that's for the revenue and capital. And what problem do we have in this country? Do we have problem of revenue, or we have problem of capital? What do you think we have? Is it the problem of revenue, or capital, or the problem of expenditure? Do we have problem in spending, or we have problem in generating? What do you think we have? What problem do you think we are facing as a country? Look at the budget sometimes when you see building of road, the amount they mark for the road in the marble, or just a car park, and you see billions of dollars to just do this small thing, or buying of the film, and you see millions. How much did they sell for film or spray? Just build around the Instagram, and you see millions budgeted for it. And that's where we have found ourselves. So the books of original entry. Let's move into another one. So if you are with me, so please, can you just type 3. If you are playing with me, if there's anything, just type 3. Let me know that we are together. We are together before I move into this next one, book of original entry. Yes, thank you, Solomon. If there's anyway, there'll still be room for questions and everything. There'll still be room for everything, but I would maybe just type 3. Like yes, enough. I'm only seeing 2 people. Where are the rest? What about the rest? And also book of original entry. Yes, okay, thank you. So the books of original entry, also known as the book of prime entry, also known as the primary book. These are the first book. It's also known as the first book. They are the book of original entry. Every transaction, there always be an entry. So there's a book created. This is the original, this is the first book. This is the first entry. This is the primary book where all recordings, all transactions, all financial from the source document. You take it off the source document. You take it off from the source document and you start recording. And this is what we call the book of original entry. This book of original entry. So these books serve as the first point of entry for various transactions before they are summarized and transferred into general ledger. So what are the first? So that's when we are talking about journals. That's when we'll be talking about journals. So the primary purpose of this book is to systematically record transactions as they occur, in order to maintain an organized and detailed record in the company, in order to maintain to have a organized and detailed record of the company's financial activity. So what are the books of original entry? Yes, we have. So now this is what we have for the books of original entry. We have the cash book, we have the sales journal, we have the purchases journal, we have the general journal. These are the books of original entry. As I've said, as it's been said, book of original entry. That means you get the document from. So if I may ask, what are the source documents? Where do you get your information from? For you to now record all these things into all these journals. Your invoice, when you make sales, there's an invoice, you get your financial transaction from invoice, you get it from receipts, you get it from checks, you get it from bank statements, you get it from your credit notes, you get it from your debit notes, you get it from your petty cash. When you have petty cash too, you're giving a small amount of money, okay, spend it this way, you are going for transportation here and there. So all this, even the text message you get, the SMS alert too, is also a source document, also which can use to get your information and everything. Then when you now get all those information, it's now recorded into this book of original entry, the primary book, the prime book we are talking about, the cash book. And what is cash book? So you record all cash transactions. All cash transactions. That's what we do on cash book. Then we make sales. Just put sales, the corresponding entry will be cash. You purchase with cash, the corresponding entry, just put cash, the corresponding entry will be purchased. You get what I'm saying? So you make sales and they pay the money instantly. So just record it under your cash book. So records all cash transactions, including cash receipts and cash payments. As you are making the payments and you make and as money is coming in and everything, you make that record on your cash book journal, on your cash book. Then sales. So you only create this sales journal when you make those sales on credit. It was not on credit, it will have been on a cash book. But because you made it on credit, and mind you, we are looking at concepts, principle, that it is not until the money you receive the money before you record it. In as much you made that transaction, you earn it, you sold it, you record it. So when you now record it and payment has not yet been made, it's going to be on that sales journal. So we record all credit sales transaction there. Then purchases. Also, same thing applies as it applies to sales, it applies to purchases. So we record all credit purchase of goods and services on credit. Or record all credit purchase of goods and services. We understand. You made a service for someone and yet you pay someone's fee or someone and yet have not paid. So we record it under purchases journal. And then we have our general journal too. That's non-routine or adjustable transaction that does not fall into sales, that does not fall into category purchases. So we record it under journal. We record it under journal. So please. So what are the uses of ledger? Uses, okay, that's for journal. Then after recording your transaction in journal, then the next is the ledger. Mind you, let's look at the stages, the processes. You get all your transactions, all the transactions from the invoice you issue, the receipts, the issue, the bank statement or thereabout, the checks, the credit note, the debit notes, all those. Once you get all your paying slips, the paying slip and everything, you get all those information. You record it into the journal. The cash, the meant for cash, the ones meant for credit purchase, and then credit sales, sales journal, the ones meant for purchase journal, we record it, the general journal to record it. Then thereafter, the next stage is now ledger. It moves from journal, it comes to ledger. It moves from journal and it comes to ledger. So from there, the work of an accountant is showing forth. The work of an accountant showing forth with less the bookkeeping aspect. Now, accountants now work now as when I think it's more complex and it's more compound. It's not really complex, but more compound. Unlike a bookkeeper, just record and that's all. But now more compound now. So ledger. The ledger is the fundamental book used in accounting that organizes and summarizes all transactions of a business. You don't have to write in word. The way you write it, people will understand. It's the same language also. It's the same language. Figures, the same language. Cash, this, bank, this. Everybody on you don't need to understand Greek. You don't need to understand. It's the same language also. It has one language. So that anywhere you pick it, they understand what you have put down. You understand it. So from the ledger, it summarizes them, it puts it in summary of all transactions that happen from day to day. Summarize everything. It contains separate accounts for each financial element. You have the ledger for assets, for liability, for equity, for that's your capital, your revenue, your expenses. Create ledger for it. You create ledger for it. So ledger is where data from the book of original entry, as I said. So ledger is where the data you get. The data you are bringing into ledger, you get it from the book of original entry, that your journals, your cash, your sales journals, your purchase journal. You get it from there and you bring it to the ledger. That's where you post it. You transfer it to that place. So that's where you transfer it to the place. So it involves taking the information from this primary book and entering them into their respective ledger. Take it from the primary book, now take it to their respective ledger. So for instance, so if a transaction involves a sales on credit, so the details of that sale will be initially recorded in sales journal, as I've said. The transaction you made a sales and it was on credit. Normally you record it on your sales journal. You record it on your sales journal. So later, so these details will now be posted or transferred to individual accounts in the ledger. It's now be posted. We're going to do practical by next, either here or this session, or when we'll meet in the next session. Also, we do the practical aspect of it, the calculation aspect of it. So leave your sales journal, because you have a sales journal, then you have a ledger now. Having the name of that person, having the name of your debtor, the person that's owing you, the receivable, that wants to collect money from. So such as the account receivable, like the debtor, for the amount you owe and everything, and same thing. Yeah, so that helps in the organization, ledgers help in the organization and classification of financial information. It helps to organize it and classify it very well. So they provide a detailed record of each account transaction. Each account transaction, allowing business to track their financial performance and prepare financial statements. You can now see that is where financial statement is coming up. Your profit and loss account, your balance sheet, and then it's come like so you from the ledger and everything. So ledger contains a series of individual accounts. You all know that, so debit and credit side and everything. So classification of ledger. So ledger is also classified into the personal ledger. We have the sales ledger and purchase ledger. Also, we have the journals too, the sales journal, purchase journal. So we also have personal ledgers. So that are suppliers, the personal account, our customers and everything. So these are personal ledger, whereby we sell goods, we sold goods to someone, credit. So it is being recorded under sales ledger. So it contains, so your sales ledger will contain all your debtors, those who are owing you. Then your purchases, you purchase some goods, you've not made payments. So there's a ledger for you to purchase ledger to show your supplier, your creditor, your suppliers, the payments you need to make. Then the general ledger, we talked about all other things apart from the sales and purchase, which the expenses, the income, the day-to-day activities and everything. So that one shows that too. And also have private ledger too, which is, it talks about your capital, your drawing, the one you use, you kept for private use. So that's the classification of ledger. And the nature and specimen of the ledger. So this is how ledger looks like. After taking it from journal. Journal look more or less like journal look more or less like dates. You have your particular, then you have debit and credit. That's how journal looks like. There's a slide there where I think I have it there where we pull out debit and credit. That's for journal, but for ledger. So this is how it looks like. So it is divided into two separate sessions. It is divided into two. Look at it very well. You can see date particular folio amount. Another one date particular folio amount. You can see on my left is debit side. The left side is debit side. So your left side is always, so when you are telling you debit is and credit is, so when you're recording it, for either on the debit side or you're recording it on the credit side. Now you're recording on the debit side or you're recording on the credit side. So the operation DR means debit. It's not doctor. It means debit. So just know that the DR means debit. So that's the abbreviation for it. Why the CR means credit on the right side. So debit side receive value. Because we talked about the book of original entry, the principle of double entry. So debit side receives, credit side gives, debit side receives, credit side gives. So, and it has column for date particular, folio amount for both sides, which I've said, and everything. So folio is also known as page, where number. So that folio is not really necessary. So then after all records have been done, I wish I do some examples. Okay, let me share one screen. Maybe we can look at this ledger, which we can work on. We can all look at it to have a fair idea, so you will really understand what we are talking about here. Just give me a quick second to share that. So can you see my screen from this word aspect? If you can see my screen, just type something. Type one. You can see. So let's just do a few examples for you to have no idea of what I'm talking about. If you can see my screen, type 2. Like you can see. Type 2, you can see. Okay, we see. Maybe 1. I guess you can see. All right, good. So let me go ahead. So I've shown you the format, how it looks like, the particular folio number. So let's look at an example. only commence business with 300,000 in the bank. You know, we talked about this earlier on. Only commence business with 300,000 in the bank. Two accounts that's been affected. Identify the two accounts. Only commence business. So business, that means capital. So let's assume that you are the only. Let's assume that you are the only. You are commencing business with 300,000 in the bank. So the two accounts that will be affected is what? Capital and bank. And I said from the double entry, credit what is going out. Account that is going out, account that is giving out. Capital is giving out. Capital is saying, take bank. Take bank. Only commence business and put that money in the bank because you have to have money to start a business. So the capital account is saying, I am giving this 300,000 to start business. You can now see from the next page of it, you can see the capital account, general one, is at where? Credit side. It's at the credit side. That means we put the name bank, 300,000 naira. Bank, 300,000 naira. I hope I'm clear. Then the corresponding, which is the bank, which is receiving. The bank which is receiving, you can see it's being posted at the debit side. January 1, you put the date there. And the particular is capital, 300,000 naira. Am I clear enough? You understand this? Type 0. Type 0. You understand that? So let's go at the next one. On January 4. January 4. Purchase goods 120,000 by transfer. How do you make transfer? You make transfer by card, by your bank, not by card. Oh, okay. You say I have to come again. All right. So let me come again. Let me come again. So you want to start business. So let's leave only alone. Do not just leave only. Let's say you are the only. You are the only now. You want to start a business, and the principle, the golden rules of the double entry. When I told you what you must identify, you must identify two accounts that's been affected. Commencement of business, and you want to start a business, you need capital. You all know that before you can start a business, you need capital. So commencing business means you have a capital. It's called capital. So two accounts that are affected is capital, that's commence business, and bank. Capital and bank. So who is giving out? We have two persons now. So to make it simple, we have two persons to say two accounts. Two accounts now, two persons in quotes. You have Mr. Capital and Mr. Bank. Mr. Capital is saying, take this 300,000. And Mr. Bank is stretching his hand, give it to me. Give it to me. So that's why we have capital crediting it January 1 from the solution there. January 1, bank 300,000. So any accountant that sees this already understand. That's why I said it's in one language. Keep this anywhere in the world. When they see this, you don't need to now start writing only converting business 300,000 naira and put bank. You went to bank to transport fed to the Ikeja or transport to this and went to the bank and now deposited to this account. No, you don't do it. Capital as the account, and under it on the credit side, you can see January 1, bank 300,000 naira. Then you now open the bank also to the second account, the corresponding, because the bank is the one receiving it. You took the money to bank because you want to use the money to say this money, I want to use it to start a business. So he doesn't want the money to be in his hand. So he's depositing it in the bank. They are depositing that money in the bank. So what do you do? From the bank account, you now put capital. So there's a corresponding debit credit entry. For every credit entry, you can see there's a corresponding debit entry. Let's look at the second example, maybe it's be clearer to us. January 4, purchase good, 120,000 naira by transfer. You purchase, you bought good, you made the payment. You already made the payment. This was not on credit. Just get that fact. It was not on credit. You made the payment. Two accounts will be affected. Two accounts. You purchase the goods. That's purchases. Purchase accounts will be affected. And transfer, which means that's your bank. That is your bank. Also affected. So which account is taking and which account is receiving? You made transfer. You took your phone and you typed star this, and you got an alert. Boom. You got an alert. Money has removed from your bank, from your account, from your bank account. Money has removed. That is why it's on the credit side, because the money is going out. So general report, because it's going out to purchase something, to purchase the goods from goods. So 120,000. And your purchase account, because that one is receiving it. You open a purchase account, then put bank, which is the one giving it to you. The one giving out the value, 120,000. Generate 5. Also, paid wages, 80,000 naira by transfer. Paid wages, 50,000 naira by transfer. So two accounts will also be affected. Wages and what? Bank, because it was transferred. It was by cash. Paid wages by cash. No one does cash these days. You do your alerts and everything. Paid wages by alert, bank alert and everything. So it was paid by cash. It will have been cash account open. Wages also affected. So what is going out? So the cash account is one, the bank is one releasing, is one giving out. The bank is the one giving out. That's why you can see it on the credit side. Wages. It's giving it to wages, 20,000. And wages account, wages as an account is receiving it. It's receiving it. Lastly, sold goods to Sheldon on credit. This time around, it was not cash, it was not bank. It was sold goods to Sheldon on credit. Sold, when you say sold, it means sales. It means sales. Bought means purchases, or they can put purchases there, or they can bought goods. I started business, that's capital. Sold goods to Sheldon 150,000 on credit. So Sheldon is here to make payment. Sales is affected, and Sheldon will be affected. It was not on credit. If you paid outrightly, it will just be cash, because it will just be cash will be collected. You will be getting the money because money is coming in. So under your sales, you put, but you are selling to Sheldon, because sales is the one going Sheldon 150,000. Then that one the under Sheldon account with sales. So anybody that sees, you know that we make sales. That means Sheldon bought some things from us and it's yet to pay. That means he has to pay. That's what he's saying. This is what he's saying. So if Sheldon now pays this money, what do you think will happen? That means you will now credit Sheldon, because Sheldon is now giving out. So you will now be at the credit entry 150,000. If Sheldon now pays the money, it will now be at the credit entry, and he pays the money. If it is through cash, they just put cash 150,000. So it will mean both sales and Sheldon making the account balance. There won't be the corresponding entry, debit entry for this Sheldon. It's now the cash which you pay. One is now coming into your cash account. It's now the debit side. It's a transfer. So now the bank. It will now be two bank. I hope you understand this. You can understand, please indicate fine. You understand it, please indicate fine. You know that yes, we are all together in this. Indicate fine. You understand this. So, let's look at that. I'm not seeing any record. To understand this, just type in 5 below. If you still need more explanation, so I can always explain more for you guys. Understand it? Trying to share my screen to go back to where we stopped. Okay. Okay. That's where we stopped. Do you all understand? Okay, clear. Honesty, still don't understand. Okay. Let me still hear other people. Let me see other people. One thing is that you have to know the principles. You have to know the principles. You have to be learning it, write it somewhere. Let it ring in your memory. Let it just be in your memory. So that will guide you. That will always guide you and everything. Just know the concepts. You have to know the principles for every debit entry. So all these two accounts that will be affected. For every debit entry, there's always a corresponding credit entry and vice versa. You just have to know things. Any other people, let me know before I move to our balance. Before I move to our balance, the only needs to explain further concerning it. Not to example again, so some people can get it. That's the main focus for the objective of this. You have to know it. It is very important that you know it. It's highly important to know it. So let me give you another example. Another example. Another example. Now you can see my screen. So general return. Let's look at general return. Let's look at general return. We drew cash 150. Sorry. We drew cash 50,000 from bank. You went to bank and you drew cash and you withdrew money. 2 accounts will be affected. Please note this. You went to your bank, or you went to the ATM to withdraw money. 2 accounts will be affected. That's the cash account and the bank account. The cash account and the bank account. So which one is giving? Which one is receiving? You have to know from that two. Do not look at any other account. That 2 accounts you have identified. Which one is giving and which one is giving? In your bank account, you have this amount. You have, let's say you have 100 naira in your account. And you took, and bank account say out of this 100 naira, then you take 30 naira. Then you release 30 naira out of the 100 naira. So your bank has released 100 naira and giving it to your cash. You now have it in your hand, cash, because there are some accounts you need to keep for you to track your money. You track the record, you track your money, you have to track. You have to keep track of this money. This money, where did it go? What did I use to do? Did I used to buy this? Did I used to purchase this? Did I used to pay this? You have to keep track of it. So there's always a record, an account. So you took the money from the bank. So you have an account that the bank is giving it out. So that is why it's on the credit side, January 10, cash. Because you took it by cash, 50,000 naira. Then your cash account, you withdrew it from bank, which is in debit side because the money is coming to the cash account. So from your cash account, if you open your cash account, you see that I have 50,000 naira in my cash. That money, 50,000 naira has not look at it I have, but 50,000 naira has come into my cash account. But 50,000 naira has moved from my bank account and has come into my cash account. Look at it that way. Now, receive commission in cash, 25,000 naira. Receive commission in cash, 25,000 naira. Receive commission in cash. So accounts is affected. You receive commission, you receive commission, 25,000 naira. So 2 accounts, commission accounts and cash. So under your commission receivable, that's another income for you. And there's credit income. Anytime you see income, credit income. So you just go back to it from the slide. These are standards. When it's income, credit it. When it's sales, credit it. This is a transaction, credit it. So income receivable accounts, because that one is income is receivable, income. Commission receivable is one giving out the 25,000 naira and going to your cash. So you have it that I received a commission, 25,000 naira, and it's coming to my cash, and I have it with me the cash. You have the commission, 25,000 naira. So a lot of time I would think I have to put a stop to that. You still have more practical concerning it going forward. Still have more practical concerning it going forward. So back to slide. Back to the slide. Yes. So after the journal, after your source document, you've gathered your source document, you've gotten all the information you need to gather together to be able to make a whole financial statement. You've gathered everything, you record it in your journal. After doing that in your journal, you transfer it to your ledger, whereby you have each account separately. You have each account for assets, for liability, for this and that and everything. Then after that, what next? See the work of an accountant. See the work of an accountant. What next? Trial balance. The next thing is for trial balance. I guess some of you will be familiar, even not all, with trial balance. Must have had it in your secondary school, this and that and everything. So comes to your trial balance. What does trial balance do? So trial balance is a statement. Trial balance is a statement that lists the balances of all general ledger accounts at a specific point in time. All those ledgers, you see it there. You post it, you bring it to trial balance. And the main focus of trial balance, the main primary focus of it is to test accuracy, arithmetic accuracy. See the word balance. It must balance. That is it. So trial balance. So it must balance. So that shows that yes, if it's balanced, it means that your statement is showing the true and fair view. It's truly showing the true financial position of your account. So it is balanced. So you want to start business with 100,000, you bought this, you bought that, you pay for this, you pay salary for this, you pay this and that and everything. And you now bring everything to a balance. You must balance. This is how you spend all the time. Not where did I spend this 5,000? I can't remember where I spent it. That's the essence of keeping record. And you see there's a shortfall of 5,000, or there's a shortfall of 10,000, there's a shortfall of 20,000. That is where fraud are being detected. When money are being, okay, we want to do this, we want to do that, and then you start tracking, okay, you do this is the evidence, you do this is the evidence, you do this. But there's no evidence. Where is it? Fraud are being detected. So trial balance is a statement that lists the balance of all ledger accounts at a specific point in time to test arithmetic accuracy of the account, to test arithmetic accuracy of the account. So that's the primary purpose. So it ensures that the total debit equals total credit. So the debit side we're having and the credit side we're having, the debit side must be equal to the debit side, credit side. So if you have the debit side 1 million, the credit side must be 1 million. Because for every debit entry, there must be corresponding credit entry with the same amount of value, the same value. So that means, so for immediately you detect that it does not balance, then you know that something needs to be wrong. You need to go back, do an audit. Where have I missed it? Where did I not get it right? You need to go back and check. They serve as a primary check for errors in accounting records, which to create financial statements. So this is the feature of trial balance. So it has particulars, debit, and credit. There's a format for it as I've shown you for the journal, for the ledger. So it also has its own format. So you just have the particular, that means so the account, what kind of account it is, and debit side and credit side. Please, let me, if you are still with me, please type in 5. If you are still together and you are still on the same boat, you are still on the same ship, cruising together, please type in 5. And no, it's not that I'm the only one sailing. You are with me, type in 5. Because I need that response before I can move further. So I can move further. Yes, Michael. Thank you. It's not only myself and Michael that's on this boat, on this ship. So another please, if we are there, type in 5 so I know we're all together. So achieve the same thing. Yes, thank you. Thank you. Yes, the rest, please, And before I move further, I need 2 more. Okay, yes. So let's go ahead. Yes, thank you. Yes, thank you. Thank you. So the nature of trial balance. So as I've told you again, let me refresh your memory. You get all your transactions from all those source documents, your pay slips, your invoice, your receipts, even your alert you get from your phone. You get your petty cash books, your credit and debit, you get all those things. You get all those things, your bank statements, you get all those records. You record it in your journal, from your journal, you record it in your ledger. On your ledger now, it comes to trial balance. It comes to trial balance with our accountant prepared this account. It comes to the trial balance. So, which you have said that trial balance is to test the arithmetic accuracy of the account. Text it that so your debit side must be equal amount with your credit side. So trial balance has column for particular debit and credit, which I've said. So all items with debit balance in the ledger will be debited. So all items in the debit balance, we're still going to look practical of it. All items in the debit balance, because after you've written this amount, okay, to cash from bank, it's also amount. So balance CD. At the end of the day or at the end of the month, this is the balance carried down. So when you put the amount, then the corresponding side for the following year or for the following month or for the following day is the balance draw down. So from that balance draw down, we bring the trial balance. So all items will be debit balance in the ledger will be debited, and all items will be credit balance in the ledger will be credited. And the total debit must be equal to total credit. The total debit must be equal to the total debit credit. So this is the format for it. This is the format for trial balance. There's the format for it. So rules of trial balance. In preparing trial balance, the rules must be followed. The rules must be followed. This format is the rule. Assets has to be on the debit side. And you know the asset we talked about it. You know what the assets are. You know what assets are. Must be, write it down, write this thing down. The assets must be at the debit side. Your liabilities will be at the credit side. Your expenses will be at the debit side. That's the balances. And then when you come to your ledger, the balance carried down. So if you are the debit side, your equity or your capital used to start business, what you have, you are the credit side, your sales and income will be at the credit side. But this is another golden rules for you to know. This is another formula, another equation for you to know. So provide a comprehensive list. So purpose of trial balance is to provide a comprehensive list of all the accounts. You have a broad view of all the accounts in everything, you'll be able to see it. So to show the arithmetic accuracy, as I've said, of the entries in the ledger, also to show that numeric accuracy, then the debit side must be equal to the credit side also. They provide data for the declaration of trading profit and loss accounts. They provide the data you need, the information you need to be able to now proceed to the next, which is now the trading profit and loss account, and thereafter balance sheet. So trial balance provides it. Trial balance provides it. So that's it for the purpose of trial balance. But from that trial balance, which we said that it takes the arithmetic accuracy of it, but there are some things that happen whereby you will not know. The account, the trial balance will balance, but you will not know that there's error in it. You will not know there is error in it. Excuse me. You will not know there is error in it. So errors not disclosed by the trial balance. Like I've said that the two sides, the debit and the credit side of the trial balance must be equal. So, but if it is not equal, that means there is an error. If it is not equal, it means there is an error. If it is not equal, excuse me, it is not equal. Okay. Yes. Looking at I'm seeing the information. So if it's not equal, there's an error. But there are some times whereby it will be equal, but the error is still there. The error will still be there. It will be equal, but the error will still be there. So in some situations where there are errors which will not be disclosed by trial balance, this error are referred to as error that do not affect the agreement of trial balance. So what are the errors? We have the error of original entry. Error of original entry. So it's the error of original entry. So the error occurs when a wrong amount is entered on the debit side and the credit side. That's original entry. Instead of it, you look at sales of 65,000 to Toby came to buy a good from you for 65,000 naira. But when you were recording it, you recorded it as 56,000 naira. You recorded it as 56,000 naira. It will not affect because what you recorded on the debit entry is the same thing you recorded at the credit entry. The same 56, 56. If it was 65, 56, you might say, you will do this one. But 56, 56, that's what you recorded. So it will not affect it around, but there is an error. There is an error. So these are that one is called error of original entry. We have error of omission. That means you completely omit that transaction. You don't even record it at all. So that is an error itself. In an error itself, you completely omit the error. So that is sales of the 65,000 naira to Toby has been completely omitted from the book. We call it error of omission. The accounts will still balance, but they are not showing a fair view of the account. We have error of commission. Error of commission. That means you wrote the right amount, but you recorded it in the wrong account. You recorded it in the wrong account. Now, purchase of goods of 10,000 naira from buyer. Buyer bought it. Instead of you to record it under buyer as a creditor, but you record it under, instead of it to be under buyer, but you record it under buyer. Because of the name, you never knew. You never knew that name confused you, but you record it in the wrong account. And that's error of commission. And we have error of principle. So error of principle, this is when you record something in the wrong class of account. What is meant for capital item, you went and put it under revenue item. That's the wrong class of accounts. Wrong class of accounts. When you purchase vehicle like somebody Uber guy that I said, now putting it under expenses as a car that you purchase as an expenses. No, it shouldn't be. It's supposed to be the fuel that should be under the expenses, that class of account, the expenses account, servicing of the car, or maybe repair, inflating the tires or thereabouts, and that will be. But now putting a car that will be used to generate even more income, now recording it into that extent. So that's the wrong class of account. That's error of principle. It's not following the concept and convention. And we have compensating error. So these occur when error of the same amount are posted to the two sides of the ledger. So therefore, they have to cancel each other. Compensating error. This error occur when the same amount are posted in the two sides of the account, the two sides of the ledger. So with that, the only way you do it is that you lay it off, you cancel each other. So complete reversal of entry also, as you see that when you receive a cash from Baba today has been entered on the credit side, and also that this occur when the double entry of the transaction is reversed. The amount to be debited has been credited, and the account that ought to be credited is debited. You did a reversal. You're supposed to debit this. We are now crediting it, as we did the debit and credit, the bank and this. The one that is meant to be debited, you put it on credit, and the one that is supposed to be credited, you put it in debit. So we are duplicating error. That means we are making the error. We are the transaction 2 times. So or more than 2 times. We've already recorded this transaction and you're recording it again. So this is called when a transaction is recorded more than once in a book of account. It's recorded more than once in a book of account. So for these procedures to be followed when correcting these errors, what are the procedures you have to follow? To identify the type of error. When you see it, you have to know what kind of error it is. Is there error of commission? Is there error of commission? Is it principal error? Is it know the kind of error it is? Is the error of double entry? Is it duplicating error? You have to know what kind of error. When you know what kind of error it is, then you identify the 2 accounts affected by that error. You have to identify those 2 accounts that error affects. Then interpret the error in the ledger. As the error was stated, as you've seen the error, just interpret it, write it down as it is in the ledger. Then what do? Then you do the correction. Prepare the journal back again, and you do the correction on it. You do the correction back again. Because by 12, I think we should be on a break. So I'm trying to look at the time, so we don't use part of the break for this lecture again. So we've spoken about journal. We've spoken about journal. So you can see this is the formula for journal, date, particular, debit and credit. We've spoken about it and everything. We have the account to be debited. So it is a bank account to be debited in bank. If you cash went to bank, you withdraw money from bank to cash. That means what do you debit? You debit cash because cash is coming in, the bank is going out. So what do? You debit your what? You debit your, what is that? What do you debit? You debit your cash because cash is coming in. You withdraw money from bank. Cash. You do cash from bank. So you debit your cash and you credit your bank. Then you write a description, brief description. Withdraw cash from bank. Withdraw cash from bank. That's the journal. I've said that journal is another person to read it. So it enters on a daily basis and then classified into debit and debits. Debit and credit serve as the initial entry point in the accounting process where transactions are recorded before being transferred to the general ledger. Spoken extensively concerning that. Essentially concerning that. So classes of journal entry. Classes of journal entry. We have in one account, simple entry. You see, by next session, we do practical at all these things. So you understand it better. You understand it better. Or take some of your those books and look at it again to look for that to know it more. So simple entry means that it's just one account will be debited and one account will be credited. One account will be debited and one account will be credited. It's just one account, just as we've seen from the formula here. Account will be debited and account will be credited. X. And so you see the description. So that's for simple entry. But for compound entry, it's that one account will be debited and several accounts credited, maybe salary. And who are those who pay salary to? And who are those who pay salary to? Chevron, this amount is this amount. So you can now see internal house. So the salary, the total salary could be 100, but you paid Chevron 230, Aye 225. Another person took another 25, another person now took 20, which now makes it 100 to now balance each other. So that's what it's talking about, compound entry. So one account may be debited and several accounts credited. So same thing to several accounts may be debited and one account debited. But at the end of it all, the amount will still be the same, but you just have different class of accounts. That's different class of accounts. So several accounts are debited, and also we can have also several accounts, like your sales too. You can have those who are owing you sales, so you can have their names and the corresponding entry too. Then they can have just one account. There can just be just one account there, but at the end of it all, it has the same amount. So that's like the kind of entry journals we will see as we proceed in this lecture. So use of journal. So that use of journals, you can use also to correction of error, recording of disposal of fixed assets, everything. Purchase of fixed assets on credits, local transaction that will not occur regularly, for recording, closing balance of entry, and things like that. So we have so bank reconciliation statements. Another topic, bank reconciliation statement. So you're all familiar with bank statements. You all know, I believe you all know what bank statement is. So with this time I'll be looking at reconciling your bank statement with cash book, reconciling your bank statement with your cash book. So you're reconciling, you want to know actually what we are recording, the same thing we have in our bank. The same thing we have, the amount is also the same thing we have in our bank. So we need to know that. So this is the statement that is prepared by an account holder for the purpose of finding out the difference between the cash book and bank statement balance. Difference between the cash book and bank statement balance. Sometimes you always have a record. I know how much I have in my account. I know how much I have in my account. I should be having to amount. Well, you may see when you just get an alert, you see the discrepancy. What happened? So you have to do what? You have to walk back to reconcile what would have happened. Did hacker hack my account? Did I make payment that I did not remember to record, that I was not familiar with, because I was having it in my mind that it was 100,000 I had in my account. But lo and behold, what I have in my bank statement is just 80,000. What happened to 20,000? But lo and behold, I'm having 120,000. I thought I have 100,000, but it's 120 I'm having. What would have happened? So this is the essence for this bank reconciliation statement. That's the essence for this bank reconciliation statement. So there are reasons for the disagreement between the bank statement and the cash book. What would be the reason whereby your bank statement is not agreeing with your cash book? We have unpresented check. Even though as civilization is going, as technology is evolving, check is going to extinct. Check, before you know, check is going to extinct. Nobody, people are not using paper things again. Paper things is going and facing out. So everything is just through your phone, just dial this and that, and voila, get what you want and everything. So, so what could be the disagreements between your cash book and your bank statement? You have your presented check, unpresented check. 10 minutes to go. So, what we think about presented? So these are checks that you have issued that check. So I want you to pay close attention to this. You know you have this 50,000 in your account and you have a check. And you want to give your brother, 10,000. The brother has come to you. Oh, my brother, please, I need money and everything. And you brought out your check. You wrote it. So name. Pay this 10,000 naira. And you give him that check. So you know you have 50,000 in your account. And you're giving him that check of 10,000. Now, you have already removed that 10,000 naira from your own cash book. That means I know, okay, I'm not having 40,000 since I'm giving my brother 10,000, so I'm having 40,000. But your brother has not taken it to bank to cash it. And at the time you were trying to reconcile your bank statement, at the time you print out your bank statement with your cash book, is yet to get the check still with him, but is yet to present it to the bank. That means your account, your own account, your own personal account, which you will be looking at, you will be monitoring, you'll be written down, it will show 40,000 naira, but your bank account will show 50,000 naira because your brother is here to take that check to account to cash it out. So that's what we call presented check. So it will not make it will not make it balance. That's where you have to reconcile. You have to reconcile that, oh, okay, my brother is yet to present that 10,000 naira, reason why I'm having an increase of 10,000 naira in my bank account. Also, the zonal check, quickly. The zonal check. Sometimes you take check to bank because there are rules on checks. So when you get to the bank, they might dishonor it. The reason why they can dishonor it is that your signature is not the same signature you used when you were opening that account, because they will ask for your signature. The difference between they might think maybe somebody else is trying to forge your signature. As a result, they will dishonor it. So if there's irregular signature, the signature is not the same. There's the signature you're using for account, and there's another signature you're using regularly, and you mistakenly put another signature which is different from the signature you use. So it will be dishonored. When there's insufficient funds in your account, it will be dishonored. When there's alteration on the check, it will be dishonored. When you paint it too much, you paint too much, you cancel. People will dishonor the bank will dishonor it. So when there's difference between words and figure, what you wrote in a word is different from figure. So it's be dishonored. Mind you, because you have already issued the check, so to you, you remove it from your own cash account. But it is yet to be honored by bank. So the money will still be there on credited check also. On credited check, that is those money that you receive. This is now time you receive. You receive the money. These are checks which have been received and entered into the cash. You receive that money. Not the money. You receive the check. Somebody gave you check. It's just the opposite of presented. You give somebody, but the person is here to take it to the bank to cash it out. Now this time around, somebody is giving you a check, and you now say, I have 40,000 in my account. With this check now, I'm not having. Somebody give you a check of 30,000 naira. With this check, which is 30, and you have cash. You have, you have 40,000 naira with you. That's 70,000. To you, you recorded 70,000 naira. But by the time you now print out your bank statement, you see there is a difference of 30,000 naira. So you enter it into your cash book and lodge in the bank, but have not been entered on the credit side of the bank statement. But yet, most of the time, especially even sometimes when you take those checks to the bank, it takes 2 days for it to mature. When you take a check, it is not on the same bank. If you are taking Zenith Check Bank to maybe First Bank account, the First Bank, but it's written in your name. You take it on a Monday, you get the alert on a Wednesday. It is the alert, and you get it on a Wednesday. You just be seeing it hanging, but it will not reflect on your total balance. So to you, you've recorded it that yes, the money is now with you, but in the bank statement, you will not see it there until after it has now matured, it has now dropped the second day. So bank charges too, because you see every transaction you make, there's always a commission, there's always a charge that the bank will always take. That's why you have the bank charges. also to meet which cause the differences also. Standing order, you make standing order that every month, please remove this, always be told you give the bank an order that every month, make sure you pay this so amount to this person, or used to pay your insurance, or every year at this also date, remove the pay subscription to this also person thereabouts. So that's standing on that. This also causes differences, discrepancy between your cash book and your bank statement. Also, and credit transfer. Also, this one are checked or cash received directly by the bank on behalf of the account holder. And you don't know. A lot came in, but you don't know there was a transfer. You don't know who had done it. Somebody gave you a gift, and you don't know until you now, and you didn't receive a lot. Once you now print out the account, you now discover that, so this person gave me this money. Well, this person promised me, so that's paid. Be able to see, and also dividends. So if you have shares in companies, you pay directly to your account. You pay directly to your account. So these are things that can cause disagreement between your cash and your bank statement, between your cash and your bank statement. So that is what we have. Then treatment. How do you treat it? So how do you treat bank reconciliation statement? So you prepare the preparation of bank reconciliation statement starts with either you start as balance as per cash book. That's the way you want to start it. Or because you work back, you are starting with, okay, this is the balance you have as per your cash book you've been preparing. And you start to add the presented check on this back. So you have work back, so you now get the balance as your bank statement. Balance as per your bank statement, you work back. Or otherwise, you can do preparation of bank reconciliation, starting with balance as per bank statement. Then you now working back. You now get the balance as per cash book. Same thing for adjustment of cash book and preparation of bank reconciliation, another method again. But we're focusing more on the first two. Sometimes you just do assessment of your cash book, you do adjustments, you create a cash book account itself, you do the adjustments, and then now make the bank reconciliation statement, which that one takes long thing. But the simple ways, the first two, very easy. And you can see the formula for it, the format for it. Method one, you are looking at the balance as per cash book. So this is the amount you're having, XX is what you're having as per your cash book. Then what do? The check that you issued to your brother that is yet to present at the bank, you had it back to your cash book. You had it back. Dividend. So the dividend is supposed to come, the dividend, the money you received, but not yet entered. So you put it there, then you less uncredited check, the check that you received, but yet to present, you are yet to take it to be yet to be credited to you. So that's what. So you let bank charge too, bank charge their own too. You less it from there, you less it from it. So I have just some seconds to go, then the solo check and everything. So these are the formats. So either one you want to apply to, you walk back. This balance and cash back, you walk back to bank statement, and then from bank statement, you will walk to cash book. So this is the format which we're going to do practical aspect of doing them. I think this will be the position. So in a few seconds, we just talk about, we all know what the position is, what the position is. So this can be defined as a foil invaluable. I will not want to, maybe in our next, because of the time, I won't want to take more of your time, but I think we still have the position we still talk about, and then you know that questions, if there are questions and everything, we'll talk about it. If there are questions again, I would like to we'll talk about it. So at this point in time, I think I would like to cut in for now. The moderator can come in, we will go for a break. Moderator. So we'll continue from where we stopped.
Thank you so much, Mr. Samuel. Thank you so much. Okay, so please, if you are here to fill the attendance is on the chat room, please fill the attendance. We'll be back at exactly 1 p.m. Please do well to join the class on time. Please don't be late. Thank you and do have a wonderful time.